Some Calgary homeowners are about to lose everything and they have no idea it is coming. People who bought in 2022, 2023, 2024, and 2025 are now selling at a loss. Investors are losing money every single month. Families are missing payments, and mortgage delinquency numbers across Canada are climbing fast. This is not a small problem. This is a full mortgage stress crisis, and Calgary is right in the middle of it. In this video, I'm going to show you exactly what is happening, what it is getting worse, and what you must do right now before the bank makes the decision for you. So stay with me, because waiting too long is the most expensive mistake you can make right now. And here is a quick disclaimer. Before I continue, this video is for education only. Every homeowner situation is different. If you are behind on payments, facing foreclosure, dealing with a private lender, considering selling, or thinking of refinancing, speak to your mortgage professional, your lender, your accountant, your lawyer, and a qualified real estate professional before making a decision. The goal of this video is not to create fear. The goal is to give clarity, because fear makes people freeze. Clarity helps people move. So what's happening? The short version is this. Many homeowners bought during a period when prices were rising fast, interest rates were still relatively low, and the fear of missing out was very strong. In Calgary, especially between 2021 and 2024, we saw strong demand, strong migration, limited inventory in many property types, and prices moving up quickly. For many buyers, the thinking was simple. If I don't buy now, I may never be able to afford a home. And honestly, for many people, the fear was understandable. Rents were rising, population growth was strong. Calgary looked affordable compared to Vancouver and Toronto, and it is still the same today, though. Investors were coming in, newcomers were coming in, first-time buyers were trying to get in before prices moved further. But then the market changed. Interest rates rose sharply, mortgage payments increased, and people renewed into much higher rates. Some people who bought investment properties discovered that rent did not cover the full carrying cost. Some people lost jobs or had reduced income. Some landlords started facing vacancies or tenants who could not pay. Some properties that looked profitable on paper became negative cash flow in real life. And in some segments of the market, especially where inventory increased, sellers could not get the prices they expected. That is where someone can buy around 715,000 close later and end up selling it around 630,000. That's not just an 85,000 price difference. When you add closing costs, legal fees, mortgage penalties, realtor fees, carrying costs, repairs, and stress, the real financial damage can easily approach or exceed 100,000. That's very painful. And this is why I say the conversation must be honest, because real estate can build wealth, but real estate can also punish people badly when they buy at the wrong time, at the wrong price, with the wrong financing, in the wrong market, without a backup plan. The question is this only happening in Calgary? And the answer is no. This is not only happening in Calgary. Across Canada, mortgage stress has been rising. CMAC's mortgage delinquency data shows that mortgage delinquency rates have been increasing from the extremely low levels seen during the pandemic period. CMAC reported that the national 90-day plus mortgage delinquency rate increased to 0.24% in Q4 of 2025, up from 0.21 a year earlier, and linked the increase to unemployment trends, economic conditions, higher renewal rates, and elevated debt in expensive cities. Now, let's be careful. A delinquency rate of 0.24% does not mean Canada is in a US-style foreclosure crisis. It is still low historically, but the direction matters. The stress is rising, and in some cities, it is more visible. CMAC reported that in Toronto, the mortgage delinquency rate rose from 0.15% in Q2 of 2024 to 0.24% in Q2 of 2025, a 60% year-over-year increase, reaching a level not seen since 2012. Ontario regulators have also flagged that mortgage delinquencies have been trending upward, with Toronto reaching roughly 0.23% to 0.24% in early 2025, and Ontario's 90-day mortgage delinquency rate reaching 0.27 in Q2 2025. So when you hear about more power of sale listings in Ontario, more distressed condo investors in Toronto, more owners struggling in Vancouver, and more homeowners across Canada calling lenders before they fall behind, that is not imaginary. The numbers are still not catastrophic, but the pressure is real. And one reason it feels worse than official numbers show is this: Canadians usually do almost everything possible before they miss a mortgage payment. They use savings. They use lines of credit. They borrow from family. They skip other bills. They sell assets. They take second jobs. They carry credit card debt. So by the time a mortgage delinquency appears in the official data, the household may have already been under stress for months. That is why the official number can look small, while the pain on the ground feels large. Some will ask, what about Vancouver and Toronto? What is happening on the ground? Now, let's talk about Vancouver and Toronto because those markets show what happens when high prices, high debt, investor ownership, and higher rates collide. In Vancouver, affordability has been stretched for years. Many buyers carry very large mortgages. Even a small rate increase can create a major payment shock when the mortgage balance is large. In Toronto, the condo market has been under major pressure. Many investors bought pre-construction condos expecting prices and rents to keep rising, but when rents increase, closing costs increase. Appraisals came in lower, rents did not always cover payment, and resale prices softened. Many investors were trapped. Some could not close, some had to sell, some took losses. Some developers also faced serious financial pressure. And when developers, investors, and end users are all under stress at the same time, the market becomes fragile. That is why the Toronto and Vancouver stories matter to Calgary. Calgary is not Toronto, Calgary is not Vancouver. Our prices are lower, our economy is different, our migration story is different, our land supply and housing mix are different, but the financial mechanism is similar. If people buy at high prices with high leverage using optimistic rent assumptions and then rates rise, income falls, or vacancies increase, the math cannot break. The math doesn't care about emotions. Math doesn't care that you love the house. Math doesn't care that the property was supposed to be a long-term investment. Math only asks one question: can the property carry itself, or can you carry it? If the answer is no, then the homeowner has to make a decision. So let's see, or let's check what is happening in Calgary right now. So let's bring it back to Calgary. The Calgary market is not one market right now. It is several markets inside one city. Detached homes in some communities may still have decent demand. More affordable homes may still attract buyers. But some segments, especially where inventory has increased, are feeling more pressure. Calgary Real Estate Board CREB reported that in April 2026, Calgary sales were 2104 units, about 6% lower than April 2025, while inventory rose and the city moved into a more balanced conditions overall. CREB also noted that the market has been transitioning away from the strong demand driven by rapid migration growth. That phrase matters, transitioning away. That means sellers cannot simply price it like it is 2022 or 2023 and expect buyers to chase them. Buyers now have more options, though financing is harder. Carried costs are higher. Investors more cautious. Some buyers are waiting, some are negotiating harder. And if a seller is in a financial distress, the market may not give them the luxury of time. This is why many homeowners get into trouble. They think, I need this price because this is what I paid. But the market doesn't care what you paid. The market cares about today's comparable sales, today's buyer demand, today's inventory, today's mortgage rates, and today's affordability. That is painful, but it is true. If you bought in 2022 or 2023 at a higher price and your property type or area has softened, you may not be able to sell for what you paid. If you refinance when values were higher, you may have less equity than you think right now. That's why homeowners must look at the numbers early, not when the bank is already sending serious letters, not when you have missed several payments, not when your credit is already damaged. Some will argue or ask, was this caused by government policy? Now, let's answer that question. The answer is partly yes, but not in a simple way. No single policy created this entire situation, but several policy decisions and economic forces came together. First, during the pandemic period, interest rates were very low. That made borrowing cheaper and pushed many buyers into the market. Second, population growth and migration increased housing demand in many cities, including Calgary. Third, housing supply did not keep up fast enough in many areas. Fourth, federal and provincial housing programs encourage more building, including rental and multi-unit housing. Fifth, municipalities, including Calgary, made zoning and planning changes to encourage more density and more housing supply. Now, those policies were not necessarily evil. The goal was to create more housing. Canada has had a housing shortage problem for years. But here's the problem. When governments push supply, incentives, density, and financing programs into the market at the same time that interest rates, construction costs, and household debt are unstable, some investors and developers can get caught, especially if they assume rent will keep rising quickly, especially if they assume values will keep appreciating, especially if they buy based on best case numbers instead of stress tested numbers. So, yes, policy played a role, but we should not reduce this to only government policy. There were also buyer decisions, investor decisions, lender decisions, developer decisions, market psychology, fear of missing out, and unrealistic expectations. The painful truth is this: many people bought good assets with bad assumptions, and a good asset bought with bad math can still become a financial problem. All right, so let's see, what should struggling homeowners do? Now, let's talk about what homeowners should do if they are struggling. If you are missing payments, about to miss payment, facing job loss, dealing with vacancy, or feeling like you cannot carry the property anymore, here is the order I will follow. Number one, do not hide from the lender. The worst thing you can do is ignore calls, letters, emails, or notices. Lenders do not like surprises. If you communicate early, you may have more options. You may be able to discuss a payment arrangement, temporary relief, amortization adjustment, refinance option, sale timeline, or other workout strategy. But if you wait until the file is already advanced legally, your options shrink. Number two, calculate your true monthly shortfall. Do not guess. Write down the mortgage payment, property tax, insurance, condo fees if applicable, utilities, repairs, vacancy allowance, debt payment, and household expenses. Then compare that with your actual income, not your hoped for income, actual income. If you're short $500 a month, that is one type of problem. If you are short $2,500 a month, that's a different problem. Number three, find out your real market value. Do not use all appraisals. Do not use what your neighbor listed for. Do not use what you need. Use recent comparable sales. If your property will realistically sell for $630,000, but you owe $650,000 plus penalties and costs, you need to know that now, not later. Number four, check your mortgage penalty and payout. Some homeowners think they have equity until they see the mortgage penalty, legal costs, arrears, property tax adjustments, and selling costs. You need a full payout picture. Number five, compare three options. Option one, keep the property. Option two, refinance or restructure. Option three, sell before the situation gets worse. Keeping the property only makes sense if the numbers are sustainable. Refinancing only makes sense if it solves the problem instead of delaying the problem. Selling only makes sense if the selling now protects you from a bigger loss later. Number six, protect your credit if possible. A controlled sale before missed payments may be painful, but it can be better than forced sale, foreclosure, or long-term credit damage. This is especially important for immigrants, newcomers, self-employed, and families who may need to qualify again in the future. Sometimes the goal is not to win. Sometimes the goal is to stop the bleeding, protect your family, and live to fight another day. So let's look at, should someone sell and go to rent? That is also another question. Most people are not comfortable with it. So now, should you sell the home and go and rent? That depends. Some people selling and renting temporarily may be the right move, but it should not be an emotional decision. It should be a numbers decision. You need to compare your current monthly ownership cost, your realistic sale price, your mortgage payout, your selling cost, your rent alternative, your job stability, your family needs, your credit situation, your ability to buy again later. If your home is costing you $4,500 a month and you can rent a suitable place for $2,700 a month, selling may create breathing room. But if selling creates a huge loss, damages your savings, and rent is not much cheaper, then the decision is more complicated. Also, if you have children in school, family stability, immigration settlement concerns, or limited rental options, you need to consider the non-financial cost too. The right question is not, should I sell? The right question is, which option leaves me in the strongest position 12, 24, and 36 months from now? That is the question. Is it a good time for first-time buyers to buy? That is another question that I get often these days. Now, let's answer the first-time buyer question. Is it a good time to buy? The answer is it can be, but only if you buy properly. This is not the market for emotional buying. This is not the market for stretching to the last dollar. This is not the market for assuming prices will bail you out. If you are a first-time buyer, this market may give you more choice, more negotiation power, and less pressure than the peak years. But you must stress test your numbers. Ask yourself, can I afford this payment if one income drops? Can I handle repairs? Do I have emergency savings after closing? Am I buying a property type with too much inventory? Is the condo fee reasonable? Is the location strong for resale? If I had to sell in 2 years, will I be trapped? Can I rent part of the home if needed? Can I carry the home without relying on unrealistic appreciation? A good time to buy is not just about the market. A good time to buy is when your personal finances, the property, the price, and the financing all make sense together. For some buyers, 2026 may create opportunity. For others, waiting, saving, improving credit, reducing debts, or buying a smaller property may be wiser. What should investors do? And that's another segment that keeps asking what is happening in this market. For investors, this market requires discipline. If the property does not cash flow today, do not assume future appreciation will save you. If rent growth is only 0 to 1% and property values are flat or declining, your underwriting must be conservative. Do not buy based on fantasy rent. Do not ignore vacancy. Do not ignore repairs. Do not ignore property management. Do not ignore financing renewal risk. And please do not buy a property just because someone says it qualifies under a government program. A government incentivized program does not automatically make a good deal. A low down payment does not automatically make a good deal. A new build does not automatically make a good deal. A legal suit does not automatically make a good deal. The numbers must work. If the property only works with perfect tenants, perfect rent, perfect appreciation, and perfect interest rate, then it does not work. That is not investing. That is hoping with a mortgage attached. For investors already struggling, review your portfolio property by property. Which properties are bleeding cash? Which ones have equity? Which ones can be refinanced? Which ones should be sold? Which ones are worth holding through the cycle? Do not let one bad property destroy the whole portfolio. As some people, when under stress, they just make a decision that scatters everything. So, what happens next? Interest rates are not expected to collapse quickly. The Bank of Canada held its policy rate at 2.25 on April 29, 2026, and noted that housing activity remains subdued because of slow population growth, economic uncertainty, and affordability issues. The bank also described the labor market as soft, with unemployment in the 6.5 to 7% range. Realtors also reported that most economists in a late April poll expected the Bank of Canada to hold rates through 2026, although risks remain if inflation becomes persistent. So, if you are waiting for rates to drop dramatically and rescue the market, be careful. That may not happen quickly. On jobs, the labor market is still soft. If unemployment remains elevated, mortgage stress may continue. On inventory, Calgary is likely to remain more balanced than the extreme sellers market we saw before, especially in segments where supply has increased. That does not mean every property will fall. It means buyers will be more selective, sellers will need better pricing, investors will need better mark, and homeowners in trouble will need earlier advice. The next phase of the market will reward people who are realistic, not emotional, not greedy, not panicked, realistic people who are realistic and who want to take realistic decisions. So, if you are a Calgary homeowner struggling right now, here is what I want you to take from this video. You are not alone, but you cannot afford to be passive. If you are behind on payments, talk to your lender early. If you're worried about renewal, review your mortgage before the deadline. If you are thinking of selling, get a real market value before the situation becomes urgent. If you're an investor, stress test the property with conservative numbers. If you are a buyer, do not let someone else's distress make you reckless. Opportunity exists in this market. but so does risk. And the people who will come out strongest are not the people who guess, they are the people who plan early. If you're in Calgary or surrounding areas and you need help reviewing whether to hold, refinance, sell, or buy, reach out. I can help you look at the real numbers from both the real estate side and the mortgage side, so you can make a decision based on facts, not fear. Because in this market, the goal is not to just own property. The goal is to own property without letting the property own you. And if you enjoy this video, please like and subscribe and share to anyone who may be in this situation. The name is Conrad. Let me see you in the next video. Have a beautiful day. Bye.